Method of valuation, profit method. Profit method, also known as account methods, rests on the thesis that the value of a property is related to the profit generated by the business activities carried out on its premises. It is different from the other methods of valuation because it is used to determine the rental value of property. However, because rental value is an indication of capital value, the profit method can also be used to indirectly value the property. Concept of profit method. The value of a property is not determined by the characteristic of the property, but by the business activities carried out on the property. The profit obtained from the business activities is an indication of the rent that an investor is willing to pay for the property. Hence, the higher the profit is, the higher is the rental. Rent is an indication of capital value. Therefore, the higher the rent is, the higher is the value. Therefore, value is similar as a profit. Properties that are profit motivated. Example, property with business activity carried out in premises such as entertainment center, restaurant, cinemas, race course, golf course, hotel, petrol station, and etc. Properties with monopoly. Monopoly means control over the whole or part of the market and its customer due to lack of very little competition within that business. Monopoly is divided into two types. The first one is factual monopoly. Factual or business monopoly means enjoyed by a business enterprise through goodwill. For example, when the business enterprise is well known for the services that it offers or when it has been operating in the market for a long time. While the second monopoly type is legal monopoly. Legal monopoly is enjoyed by a business through benefit it enjoys through legal provision. For example, the local authority of a town only allowed one cinema to operate in that township. Because no other cinema is allowed to operate, there is no competition. Hence, the only cinema will enjoy the good profit. Method to be considered in the profit method. The profit method equation comprises a number of components. From item given, it is important to identify which item falls into which category of components. The components shown in the profit method equation are basically the main features of the method. They illustrate what are involved in the valuation using this method. The trading performance to be usually from accounts over a minimum of 3 years. The slide shows the step in profit method. Profit method starting with the determination of the main income and minus all the government tax if related times the occupancy rate or minus the vacant rate in order to get the gross income per annum. From gross income per annum plus with other income per annum, then you will get gross profit per annum. Gross profit per annum minus the expenses per annum, you will get net profit per annum. This net profit per annum will be minused with the interest in capital and entrepreneur share, then we'll get the balance. This balance is to represent the rental per annum times with the years purchased in order to get the property value. So for estimated gross income or earning per annum, usually the information for this part is from the account over a minimum period of 3 years to establish a trend. Accounts are normally from income accounts, profit and loss accounts or balance sheet. For occupancy rate, the number of units in a building with rental expressed as a percentage of all units. For example, an apartment building with 100 units and 40 resident families has a 40% of occupancy rate. Other income per annum include any activities in the premises that give profit to the business other than major profit. For example, if you are valuing the hotel using this method, your main income will be income from the rooms. However, some hotels they provide with the parking, pay parking and restaurant. So the parking and restaurant will be determined as other income. Gross profit. The profit are still considered gross because it includes operational costs and outgoing. In order to determine the expenses per annum, you need to determine either that expenses is under purchase categorized or capital category. For purchase, they are costs of acquiring the trading item, example petrol for petrol station, film rental for cinema, ingredients for food served by a restaurant. This purchase must exclude all the capital expenditures such as purchasing pots and pans, table and chair and etc. The second expenses category is management cost. This management costs required for the operation of a business. This include wages, SOXO, transportation, license, permits, utilities, stationery, and advertisements. The cost varies from year to year, therefore need to ascertain average over 3 years. Non-recurring items should be excluded. For example, the redundancy payments, capital expenditure, purchasing of plant, machinery and vehicle, while annual allowance for depreciation of the capital equipment should be included in the operational costs. Net profit per annum is reflect amount available for rent. Need to take into consideration two items. The first one is interest on capital. Capital means the capital to start the business, not the capital to build the premises. The example of capital required for the business are projector for the cinema, utensil, cooking utensil for the restaurant. This capital usually financed by bank loans where interest is charged at a certain percentage. The interest paid to the bank is a form of cost, thus it should be deducted from profit. The second item is any entrepreneur, operators or tenant share. These are the remuneration and risk of the entrepreneur or tenant operating the business. The success of business require not only capital but also a competent entrepreneur who is knowledgeable, energetic and skilled in conducting the business. This must be compensated. Three normal ways calculating entrepreneur or tenant share. The first one is taking percentage of the annual turnover. The second one is taking percentage of total capital invested. And the third way is taking percentage of the divisible balance, which is 40%. Rental per annum. This is the indication of the ability to pay the annual rent of the property. This may not be the actual rent but the amount that should be put aside or paid as a rent. And finalize, to get the capital value, The rental per annum can be capitalized by investment method, which is the rental that we get earlier, times with the year purchase in perpetuity or term at I%, equal to capital value of the property, where I is all risk yield, the yield or capitalization rate of similar property in the locality. So type of property that is suitable to use this method, example such as cinema, hotel, golf club, petrol station and etc. Advantage of this profit method is building age will not influence the value and condition of the building also will not influence the value. However, the setback of this profit method is it's difficult to get the accounts data and not inaccurate because only focus on current picture of the business, not include future condition of the business that may be increased. Example, Pacific Hotel, which is located at Jalan Sungai, Kota Baru, Kelantan, was offered for sale. Below is the information of the hotel. The interest of the hotel is freehold and been developed on 2010. Total of room and rental rate. The hotel is accommodated with 210 of standard room with the rate of 120 ringgit per room per night and 70 deluxe room with the rate of 200 ringgit per room per night. Rental rate is already excluded with the 10% government tax and the occupancy rate is 80% in a year. The average income per year from rental for commercial and office is 850,000 per year. From the restaurant is 2 million per year. From the advertisement is 1 million per year. From the parking is 215 per year. Average expenses per year from purchasing is 1,250,000. While for the management cost is 1 million per year, for assessment is 250,000 for the first 6 months, property tax is 120,000 per year, company tax is 100,000 per year, fire insurance is 100,000 for the first 6 months, building maintenance is 20,000 per year. Business capital involved for this hotel is 2 million. The rate of return on the property is 9% per year and the interest rate for mortgage is 15% per year. Find the rental value per year and property value. First, to get the annual gross income, find the total income that received from the main income, which is room. 210,000 standard room times with the 120 ringgit per night per room times with 366 days, you will get 9,223,200. And the second of room is 70 deluxe room times with 200 times with 366 days, you will get 5,124,000. The total of the main income is 14,300. 47,200 times with the occupancy rate, which is 80%. The total that we get is 11,477,760. In order to get total gross income, you need to plus with other income. Other income involved here is rent for commercial and office, restaurant, advertisement and parking. So the total annual gross profit is 15,577,760. Minus all the expenses, which is purchasing, management costs, assessment, property tax, company tax, fire insurance and building maintenance to get the total net profit. Annual net profit is 12,387,760. Annual net profit minus the business capital, which is 15% from 2 million, you will get 300 ringgit. And minus the entrepreneur share, which is 40% from 12,387,760, you will get 4,955,104. The balance that you get for this property is 7,132,656 ringgit. In order to get the property value, you need to times with years purchase for perpetuity, which is 1 over I, for 9%, then you will get 11.1111. So the property value here is 79,251,654 ringgit and 8 cent. So you can round out to 79,251,700 ringgit.